And yet you still like Euro-denominated credit. To talk to us about your thinking there.
It's got to be bonds, right?
Well, when we look at the Eurozone, there's a number of different features from what you find in the US. So if you think about the trading picture, they've only got a problem with one of their trading partners that's potentially putting up prices because of the tariffs. The US, it's all of the trading partners. If we think about the central banking picture, the ECB's arguably got a cleaner story than the Fed. And then you've got a very big change in the fiscal stance of Germany and potentially by extension the rest of the Eurozone. So there's arguably a fiscal bridge that allows Europe to get through a lot of this uncertainty that we've just discussed. And then when we look at valuations in Europe are much less expensive than they are in the US, giving us that preference, particularly within credit, to favour Europe over the US.
Sure.
What about supply situation, supply of a corporate bond issuance? Is there too much cash sort of trying to chase quality assets right now? And specifically in Asia Pacific, what do you see?
Supply is a permanent feature of fixed income markets where you've got companies or governments that are permanently coming either to refinance their existing debts or to borrow so that they can embark on a capital expenditure or other expenditure program. What we have seen so far this year is elevated supply from a number of different sectors, but it's been very well received by investors. And that talks to a very powerful income story within fixed income at the moment, where after having a particularly troubled maybe 2022 and 2023, the real value in the asset class is backed. And that's bringing inflows in from both the wealth and institutional audience, and that's allowing all of this new issue supply to be well received and taken down by investors.
Adam, one of the funds you manage, the World Credit Fund, right, includes govies, correct? And we got through talking about how you think the curve, the U.S. yield curve, could steepen, led by the short end, mostly on Fed cuts, 2 this year, maybe up to 4 next year, right? Talk to us about what happens at the long end of the curve. And this is linked to Sherry's question on supply as well. Now that the big, beautiful budget bill is no longer a bill, but is actually law, what is Scott Bessent going to do? Right? Because we've been in this situation for, I don't know, I can't remember how long. This is a situation inherited from Janet Yellen, right? Where they were issuing probably way too much than they should have at the short end. People were thinking, okay, maybe what this guy needs to do is term it out, right? Push supply issuance to the right-hand side of the curve. So far, he has not done that yet. I can't figure out why. A lot of people were thinking, look, it's the politics. Once the bill is through, then he's going to do it. Is he?
Not sure whether he does or whether he doesn't, but what we can observe is that actually in a historic context, long-dated government bonds relative to short-dated government bonds still give you a relatively modest pickup. So there's definitely scope for investors to price in the steepening in the yield curve, maybe reflecting increased supply from the US. Perhaps what gives them pause for thought, though, is that as much as you're locking in a longer-dated borrowing, which can be good because you don't have to think about it for some time, you are locking at a higher rate. And when you've got much more debt on the government's balance sheet, which is expected to continue, they do need to have an eye on their overall interest costs and servicing of that debt. And we do know from the reaction function that we saw earlier in the year, they do care about the long end of the bond market and the potential for bond vigilantes to arrive on the US doorstep.
Absolutely.